So you guys remember talking about health savings accounts and payroll accounting? So these are amounts. Health savings accounts are, they are exactly what they sound like. They're savings accounts that can be used for health, for medical expenses. They can't be used to pay premiums on insurance, but they can be used to pay for medical expenses. They are always, in order to contribute to a health savings account, you have to also have what's called a high deductible health plan. HSA, health savings account, has to be paired with a high deductible health plan, HDHP. High deductible health plans are stated as such. They're, when you go and buy the health insurance, it specifically says it's a high deductible health plan. And it is exactly what it says it is. It has a high deductible, and that high deductible is defined. There are certain requirements that for those particular type of health plans. Now, in order to contribute to an HSA, put money in, you have to at the same time have a high deductible health plan. In order to take distributions from an HSA, you do not have to have a high deductible health plan. Okay, so it could be that you had a high deductible health plan at one point in the past and you've got money in there still. You can still draw it out for medical expenses. Okay, but in order to make contributions, and that's what we're talking about here, contributions to an HSA, because that's what's deductible, you have to also have this high deductible health plan. I don't know if your book goes through, well, they talk about the high deductible health plan. So individuals with other types of health insurance, you can't make a contribution. It's got to be this kind of health insurance. If you've got Medicare, that is not a high deductible health plan. And individuals cannot be claimed as a dependent on someone else's return. Their accounts, they're savings accounts. And they're set up by, you can get them at all sorts of banks, different financial institutions. Oftentimes individuals will contribute to health savings accounts, and they actually have no intention of ever using the funds for medical expenses. They use it as an additional way to save money, and actually high income individuals will use it as a way to save for retirement because they're making their income is too high to contribute to an IRA or a different type of retirement plan, but there are no income limits on contributing to an HSA. And you are able to invest the funds that are in an HSA in stocks, bonds, whatever you want. And you can, once in your lifetime, you can roll it over into a retirement account. So it's kind of a backdoor way of usually high income individuals contributing additional money to their retirement. So they just, when they incur health insurance or health medical expenses, they just pay cash for it. They don't draw it out of their health savings account. They could if they wanted to, but I know I had a lot of clients that were like that. They had these set up so that they could then eventually roll it over into their retirement. So it's just another way of investing and being able to shelter that income. Because this is for AGI deduction, it's going to help to reduce their AGI, right? And it's going to reduce their taxable income. If these are high income individuals, and we're talking about people who are, maybe in the 35%, 37% tax bracket, they make a contribution to an HSA, it's a big savings for them, right? As far as their taxes are concerned. Now, there are limits to how much you can contribute. For 2022, and the limits change every year. For 2022, individuals could contribute up to $3,650. Families, which would include if it's just a married couple or a single parent, anybody with more than 2 people that are in the family could contribute up to $7,300 to the HSA. And it would then reduce their taxable income, reduce their 4 AGI income, and reduce their taxable income as well. This is the form that's filled out For health savings accounts, the 8889 form, I can't remember if your tax return problem has you fill out one of these. But you can see on it, so you choose up here self only or family, so it's only you, and you can be married and have self only coverage. So if you are only covered, you're married, but your spouse has other health insurance, but you, through your employer or whatever, have a high deductible health plan, you can also have an HSA. So there's one spouse can have it and the other spouse not have it. It's just that then it would be self-only coverage. HSA contributions can be made through employer withholding, which is why we discussed it in payroll accounting. Employers can contribute to these accounts on behalf of employees, and the income, it is not considered taxable income to the employee. So it goes into the account and then the employee can use it for medical expenses. It has to be used for medical expenses, unless it's being rolled over to a retirement account that one time that you get to do that. If you don't use it for medical expenses, there is a 20% penalty on that. Usually what happens with an HSA is, and this is different from a flex spending account. Flex spending accounts, a lot of employers offer flex spending accounts that are not HSAs. With a flex spending account, it still has to be for medical expenses. It's still deductible, the amount that's contributed, only through an employer. It's only deductible at the withholding point. The limits are a lot less. I think it's like $3,000. That changes every year too. It's like $3,000 per individual to contribute to that. And so with an HSA, the money is yours. If you leave that employment, you can take it with you. You can put money in this year, and it can stay there and grow. If you don't take anything out, or you can use it for years and years and years. It's always yours. It's always your money. With a flex spending account, it's use it or lose it. So you contribute to it. If you don't draw the funds out, then eventually they get taken back from you. So those the flex spending accounts can be risky if you think you're not gonna use them. I use mine all the time because I have 2 kids that have braces. So, but that's one of the differences then between the flex spending accounts and the health savings accounts. Let's see, what else do I want to say here? If you have a health savings account, you will get a form showing contributions that were made, and then there's a separate form for distributions that were made. So, and you have to report both on the tax return. If you made contributions during the year, you have to report those on the tax return, on that form 8889. If you had any distributions, even if you didn't make contributions, but you had distributions, you also have to report those on that form 8889, because the IRS wants to know, okay, how much did you take out of your account? How much did you spend on medical expenses? Because if you took more out than you spent on medical expenses, we're going to ding you in the form of a penalty, plus you pay tax on that money, okay? So it's not just the penalty, it's also, it would be considered income. This is the form that would show the distribution. So we've got a 1099 SA for distributions, a 5498 SA for contributions, okay? So both of these forms would be necessary to have to prepare any tax returns for an individual with an HSA. If they made contributions, if they didn't make contributions, they wouldn't get one of these. If they didn't make distributions, they wouldn't get one of these, okay? Let's see. Oh, this is just kind of about how it's set up. So the HSA, they're considered to be like a trustee or custodian, kind of like retirement accounts. So it's a health plan with specified minimum deductible amounts. This is an HDHP now, high deductible health plan. It has specified minimum deductible amounts and maximum annual deductible out-of-pocket expense limitations. So the idea is, and you'll see these can be quite high. Stop it. So for individual coverage, if it's self-only, and this here we're talking about the insurance, not the HSA, okay? Has to have a minimum deductible amount of at least $1,400, maximum deductible out of pocket of $7,050. So you can see that what the purpose of the HSA is to provide funds to pay any deductible, right? And a deductible is the amount that an individual has to pay before the insurance starts to pay anything. These are very high amounts. You look for, maximum family amount is $14,100, and that's every year. So that's each year. So if you never went over $14,100 in medical expenses during the year, you had to pay everything for your medical expenses. The insurance didn't have to. All the insurance company had to do was take your money in premiums. But that's the idea behind the HSA, is to then provide the funds necessary to pay for those. HSAs are great for people who don't use health insurance very often, or high deductible health plans are great for people who don't have to use health insurance very often. So if you're healthy, young and healthy, they work really well. If you tend to use your health insurance, you have small children, or you're elderly, or you're just, you have certain health issues, they tend to be very expensive. So for the contribution amount, like I said, is $3,650, $7,300 for married. If you're over 55, I'm sorry, not $7,300 is the max. If you're over 55, you can make an additional $1,000 contribution to the HSA. And you'll see that with retirement plans too, that you'll get that. I already talked about the distributions. I'm not going to go into all of that stuff. I already kind of did cover it. Yeah, funds contain, so when you contribute to an HSA, that reduces your taxable income by the amount of the contribution. And there are no income limits. There's no phase out or anything like that with an HSA. You can make $40 million a year. You could still contribute to an HSA as long as you have that high deductible health plan. In addition, the funds in that HSA can grow in value. They can also decrease in value if you make bad investments, but it's like it can be used like a brokerage account where you make investments. And ideally you can grow it, and it grows tax-free. And as long as you use those funds for medical expenses, when you take those distributions, you don't pay tax on it. It's not income to you. So it's taken out, either taken out of your paycheck or it's paid directly by the individual, set aside in an account. It grows and grows and grows, and then as needed, the taxpayer draws money out. When they draw the money out, they don't have to pay tax on it, as long as it's used for medical expenses. Question? Yeah.
For the HSA, so are they set up as either an individual or a family, or is it just based off of if the insurance is individual or family coverage?
So it's going to be based off of, let me think about this. They're owned by an individual. It's up to the individual to determine how much they can contribute. Like if they over contribute, there's a penalty for over contributing as well. If they over contribute, then that will come out on that Form 5498 when those contributions are reported, and then that gets transferred to the tax return, and then there are penalties for that. So that's where it gets straightened out. The bank really isn't, it's not their business, or the financial institution, it's not their business to keep track of whether it's a self-only or a family account. Now there may be certain financial institutions that do that, that say, okay, is this a family account, is this a self-only account?
So they can use those funds for like themselves or any dependents?
Yes.
What about like if you're married, like is it just for you, or can like your spouse?
Anybody on that tax return
Gotcha.
can use those funds. Also, if you are, so in the case of like divorced parents, the non-custodial parent can use the funds to pay for medical expenses for their non-custodial child. So even though they're not a dependent, that would be an exception to the needing to be a dependent.
Is that
on the
something
return.
that they would just put on their return then? Or
No,
they just
it's
do
just
it
something that
in the
if
field?
questions were asked, then
Gotcha.
you would have the documentation to back it up. Great question. Anybody else?